Hi everybody, this is Ellman, the blue collar investor, with today's covered call writing question of the day. And this is actually part 2 of a 3-part series where I'm responding to questions from several of our members regarding how to calculate our final covered call writing returns. In today's version, we're going to discuss you buy a stock, you sell the option, and then you buy back that option, still leaving us in a long stock position. So the stock portion of the covered call position is still open and therefore is not calculated into our final returns. Let's take a look at the trade. Here we buy 100 shares of Home Depot, and I'm using the same trade we did in part 1. And we purchase for $69.50 per share. We then sell the May 70 call, slightly out of the money call, for $1.40, generating approximately a 2% 1-month initial return. Now you'll notice here in the blue cells where we're filling in the elite version of the Ellman calculator, this is the Schedule D, and this is tab code D3. You see the arrow on the bottom right, where we buy a stock, sell the call, and then buy back the option. The arrow above says ignore the stock transaction in this case. Now you'll notice that the date that the option is acquired is after the date that the option is sold, typical of a covered call writing trade. Okay, so now let's look over to the right side of the spreadsheet into the white cells once this information is entered and take a look at the trade. Once again, you see that the option acquisition date is after the date of the sale, 4/19 versus 3/18. All the way to the right of the spreadsheet, you'll see the S's in the column there, and that means short-term as opposed to long-term capital gains because this trade transpired over a period of 1 month. Now, in the case where we bought back the option for $2.05, we actually have a short-term loss because we purchased for $2.05 and we originally sold for $140. So that's a short-term capital loss of $65 per contract. In the scenario where we bought back the option for 20 cents or $20 per contract, we have a short-term capital gain of $120. $140 from the sale and $20 from buying back. So short-term capital gain of $120. Now, one of the nice things about this spreadsheet, it will actually tally up all of your short-term and long-term capital gains and losses. Now, of course, for covered call writing, most of these trades will be short-term in nature. So let's scroll down to the bottom of the spreadsheet and have a look. Okay, so here we see that we had the 120 gain and the 65 loss, and that nets into a short-term capital gain of $55. Now what I do is I place all my trades in here, and when the sheet is filled up, I'll print it out and start a new sheet, and prior to tax season, I will give these printed out sheets to my tax advisor to do these calculations. But once again, if at all possible, do your covered call writing trading in sheltered accounts. So there you have it, part 2 of our 3-part series, how to calculate our final covered call writing trades. And as always, I thank you for watching this video. This is Ellman, the blue collar investor. Take care, everybody.